What's up, everybody? Today we're talking about one of the most important questions you will ever ask yourself in real estate. And honestly, one of the most misunderstood questions people ask before they buy a home. And that question, how much house can I afford? Not how much house can I buy, not how much house will a lender approve me for, not how much house looks good on Instagram, but how much house can I afford? Because those are very different questions. And when you confuse them, the consequences don't show up on closing day. They show up months later, years later, when the excitement fades and the real life sets in. Most people don't realize this, but buying a home is one of the few decisions where people confuse permission with wisdom. Just because someone says yes does not mean it's a good idea, right? Just because you can doesn't mean you should. So today we're going to slow this conversation all the way down. We're going to talk about what affordability actually means, how lenders calculate numbers, why those numbers can be misleading, what the data says about housing stress right now, and how you should be thinking about this decision if you want your house to support your life instead of control it. We're going to do this in the same 3-2-1 format we always use. First, I'm going to answer 3 real questions that come up every single time someone is trying to figure out how much house they can afford. Then we're going to talk about 2 very real news stories that explain why affordability feels harder today than it did just a few years ago. And finally, I'm going to give you one framework that ties this entire episode together, because if you understand this one thing, you will never look at a home purchase the same way again. This episode is for first-time buyers, it's for move-up buyers, it's for people who feel stuck, and it's for people who are trying to avoid making a decision that they will regret later. Let's get into it. I'm Dustin Owen, and this is The D.O. Show.
They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to The D.O. Show, where I teach the lessons life taught me the hard way.
The question I hear all the time is this: how do lenders actually calculate how much house I can afford? And this is where the confusion begins. And that's because when a lender tells you how much house you can afford, what they are really telling you is how much house you can be approved for. And those are 2 separate questions. They're so far from being the same thing. Lenders use a formula called debt to income ratio, also known as DTI. According to Fannie Mae and Freddie Mac and their underwriting guidelines, most conventional loans will allow a debt to income ratio of about 43%. But with the use of technology, certain lenders will allow you to go above 43 and even touch a 50% debt to income ratio with compensating factors. Now that comes directly from Fannie Mae and Freddie Mac. Here's what it means in real terms. The lender takes your gross monthly income, not what you take home, not what hits your bank account, but your gross income. Then they look at your monthly debts. Your monthly debts are things like your projected housing payment. That includes principal, interest, taxes, insurance, and in some cases, condo dues or homeowners association dues. They look at your car payments, your student loans, your credit cards, any personal loan you may have, or any other recurring obligation. If the total of those debts stays within the allowable ratio, then for the most part, the loan's going to be approvable. And that's it. But here's the problem. That formula has no idea how you actually live. It does not know if you have kids in daycare. It doesn't know if you help family members financially. It doesn't know how much you like to travel or you don't like to travel. It doesn't know how aggressive you are at saving and investing. It doesn't know how much groceries cost in your home. And it sure as heck doesn't know your stress level when it comes to money. According to the CFPB, which is the Consumer Financial Protection Bureau, many homeowners experience payment stress not because they were approved incorrectly, but because lifestyle expenses were never factored into the decision. Approval is not advice. Approval is math, and math does not live in your house. The second question people ask is this: should I buy the maximum amount I'm approved for? It depends. Like, this is where I want you to pause. Because this question alone has created more financial stress than almost any other mistake I have seen. Just because you can doesn't mean you should, right? You've heard that before. Buying at the top of your approval range leaves no margin. And margin is what protects you when life happens. In life, trust me when I tell you, it will happen. Homes cost more than the mortgage. You have to factor in utilities, and they fluctuate based on seasonality. You have insurance premiums that pretty consistently increase. You have property taxes that, by the way, can also rise. You have maintenance, you have repairs, you have things like appliances that fail. You have roofs that age, you have landscaping. You may have HOA dues. You may have to furnish that home. And there's certain upgrades that you may have to account for. And in the words of Dumb and Dumber, you could also say, and our pets' heads are falling off when you think about what it means to be a homeowner. According to our friends over at Bankrate, homeowners spend on average between 1% and 3% of their home's value every year on maintenance alone. Now that's Bankrate data. Freddie Mac had a very similar survey about 10 years ago. What this means is that for a home that's worth $300,000, expect to spend somewhere between $3,000 to $9,000 a year in maintenance. Now, this is money most buyers don't budget for. So when something breaks, it feels like an emergency, not because it was unexpected, but because, well, there was no margin. Here's the emotional side people don't talk about. When your payment is too high, you feel trapped. You start saying no more way too often. You stop enjoying weekends. You hesitate to spend. You argue more about money. You feel pressure even when nothing is technically wrong. That's not wealth. That's stress with drywall. Buying less house is not losing. Buying less house is buying freedom. The third question I hear constantly is this: how do interest rates affect affordability beyond just the monthly payment? Most people think rates only affect the payment. They don't. According to Freddie Mac, a 1% increase in mortgage rates can reduce purchasing power by 10% or more, depending on loan size. That comes directly from Freddie Mac data. So higher rates mean higher payments, but they also mean less borrowing power. But the bigger impact is psychological. Higher rates slow people down. They make buyers hesitant. They increase fear of making a mistake. They amplify uncertainty. And uncertainty is what kills confidence. This is why rates are not good or bad. They are contextual. How do you like that word? Contextual. Smart buyers don't let rates alone dictate affordability. They look at the entire picture. Now let's talk about why this feels harder right now. Because it's not just you. One of the biggest affordability stories comes from the National Association of Realtors, aka NAR. And NAR recently reported that housing affordability remains near multi-decade lows due to the combination of higher home prices and elevated mortgage rates. Now that headline by itself sounds scary, but let's break it down. Affordability is strained not just because prices are high, but because expectations haven't adjusted. Many buyers are still trying to buy the same house they could afford 3 years ago, but that's just not reality. Then all of a sudden, frustration comes alive. According to our same friends over at NAR, affordability improves when incomes rise, when rates decline, prices stabilize, and or buyers adjust expectations. That last part matters. Expectations. Smart buyers adjust strategy. They look at different price points. They consider different neighborhoods. They reevaluate timelines. They prioritize sustainably. They prioritize sustainability over status. The market does not decide what you can afford. Your life decides what you can afford. The second major affordability story comes from the Federal Reserve Bank in New York. The Federal Reserve Bank of New York recently reported that U.S. household debt has reached record levels, driven primarily by credit cards, auto loans, and student loan debt. Ugh. That comes, again, from our friends over at the New York Fed. Now, why does all this matter? Because debt eats margin. Pretty simple. High consumer debt reduces cash flow. It reduces flexibility. It reduces safety. It reduces resilience. According to the Federal Reserve, households with higher revolving debt are significantly more likely to experience financial stress after purchasing a home. Well, duh. Of course they feel that. This is why affordability is not just about the house. It's about the entire balance sheet. Paying down debt before buying can improve affordability more than stretching for a larger home. Now let's go ahead and bring all of this together. Here is one framework that matters, and it's probably the framework that matters. Approval is not affordability. Approval answers the question, will a bank lend me this money? Affordability answers the question, can I live my life comfortably after I buy this house? Those are two entirely separate questions. According to Harvard's Joint Center for Housing Studies, households that spend more than 30% of gross income on housing are considered cost burden. That comes from Harvard. And Harvard knows a thing or two about burden and housing. Some people can go above that, sure, and they'll be fine. But others, not so much. They feel stressed. That's why affordability is personal. So instead of asking how much house can I buy, ask this: how much house allows me to still be me? Can I still save? Can I still travel? Can I still handle emergencies? Can I still sleep at night? Can I still enjoy my life? Smart buyers leave margin. Margin protects you when your job changes, when your family grows, when the market shifts, when life surprises you. And I promise you, life will surprise you. Buying less than you're approved for is not settling. In fact, some call it planning. And planning is how you win long term. So let's find a way to close this out. Understand this. The bank does not live your life. You do. Approval is a tool. Affordability is a choice. The smartest buyers don't stretch just because they can. They choose a payment that supports their life, not one that controls it. If you're thinking about buying a home, the next step is not guessing. It's getting guidance. And if you want to be connected with a TLOP approved real estate professional, someone who understands affordability, strategy, and long-term thinking, use the link in the description. I promise we will connect you with someone who actually cares about helping you make smart decisions, not just about closing a deal. And be sure to watch more episodes of the DO Show right here on TLOP Entertainment's YouTube channel. Click the subscribe button. And while you're at it, you should check out everything we're doing over at the Loan Officer Podcast. That's all I have for you for now, but I look forward to seeing you on the next one.